All right, so we had another round of companies release earnings last week. There's a handful that I want to talk about. First one, Agilent Technologies. They're a life sciences, kind of a healthcare research company. The gist of this company is good company in my opinion. They're just too expensive, right? If we get into valuations here, um, price to free cash flow is 41 at the moment. The 5-year average is just under 34. I'd be looking to pick it up below 30. So to buy this company, you'd have to be waiting for a significant pullback, a pullback that we probably will not get. If we look at the last year or so of this company, let's just look at 2 years. In June of 22, it got down to about 112. Honestly, I don't even know if that would be cheap enough, although probably close to it. It also got down to around there in March of 21. So, I mean, if it got down to there, I probably would look at picking it up. Again, obviously, my opinion. It did peak out at about 180 roughly. So that's the high. The lowest it's got 112.52. So, very good company in my opinion, but just too expensive. As far as earnings go, they did beat them by a little bit, 1.37 per share, 1.3 was the estimate. So most companies do beat earnings, so I wouldn't be too ecstatic about that. But again, it definitely a lot better than missing earnings. Um, next company, Monster. This is a company that I really do like, although again, also too expensive. If we go to the valuation, price to free cash flow of 80, 5-year average 42. So again, this company would have to come down very significantly before I would want to look it up. Although again, I do think it's a very good company because they've just absolutely killed it over. I mean, look at how much this company has grown over the last. I mean, it was below a dollar in 2004, right? Um, let's see, 10 years ago, this company has grown. This company has grown roughly 500% in the last 10 years. So just amazing, amazing growth. But again, it's just too expensive, right? They do not pay a dividend, which I wish they did, but not that big of a deal. Um, if we look at the free cash flow here, this is the king here. Again, very, very well, not the nicest growth you'll ever see, but again, you can see consistent growth over time, which is exactly what you want to see. Again, their earnings, sales were up 6.2%, although income was down. So that's a little bit concerning there. But again, we are not in great economic times right now. The lowest it's gotten over the last year is 71.78. Honestly, that still might be too expensive. I'd have to check the valuation at that, but I would definitely be wanting to buy it below 80 for sure below 80, probably even below where the 52-week low. But again, good company to keep on a watch list in my opinion. If it ever does get cheap enough to buy, if you could get it for a price to free cash flow of I don't know 30, probably would be a good buy in my opinion. Next one, Starwood Property Trust. Little bit different here. This is a company you're buying for the dividend. And again, I've talked about dividends before. I will talk about dividends a lot more. The key with dividend stocks, REITs, BDCs, mortgage REITs, whatever, the key is you got to look at the stability of share price. You also need to see, is that dividend sustainable? Another important thing too is, are they just perpetually issuing shares to pay that dividend? If you look at Starwood, they've really only issued a significant amount of shares in 2021. They actually bought some back in 2020. 2019 was negligible. 2018 they bought some back. Last year they issued 51,000. So this is the thing that I would really keep an eye on. Because if that number doesn't go down, again, to be frank, I don't own this company. I'm just keeping it on a watch list because I think it's very interesting. You want to keep an eye on this kind of stuff when it comes to these BDCs, mortgage REITs, these kind of ones. And another important thing that I don't know if I've mentioned before. I have mentioned it before in normal companies, but you got to keep an eye on this, right? Keep an eye on the share issuance, because everything else might look okay, right? Oh, they're consistently paying the dividend for 10 years in a row, right? They never cut it, but they're issuing crazy amounts of shares, right? And again, you also need to keep in mind, is that amount of shares, is that a crazy amount for that company, or is it not? Because a 500,000 shares for one company might be a 0.1%, but for another company, it's 10%, right? So that's another important thing to keep in mind. But this is one of the better some of these really high dividend companies, in my opinion, because um, so they did have a very big crash during March of 2020, but again, a lot of companies did. If you look at the last 10 years, the share price has been pretty stable, right? Pretty stable. It looks like it's actually grown slightly, and especially since the company IPO'd. So again, a good company to keep on a watch list. Again, 9.7% dividends. So again, you're buying it because of the dividend. Earnings yield is 19.71. So the dividend, just from the outside looking in, appears to be sustainable, right? I mean, the payout ratio is 50%. And again, they have never actually cut that dividend. So again, that's good to see. But I would look at the share price issuance, right? Especially when times are good, right? If companies are having to issue shares when times are good, when there's a really good economy, that's a massive red flag in my opinion. So keep an eye on that for any company. Next one is Kroger. And the one thing I forgot to mention about Starwood is that their revenue and their earnings were both up significantly, which is why I became interested in it. Kroger, again, very steady company. Although, again, people here, it's a boring ass grocery store. It must be, not very good. But again, if we compare it to the S&P, it actually outperformed the S&P over most timelines, right? 20 years it has. Let's check for 10 years. 10 years it has as well. 5 years it actually has underperformed by a little bit. So over the very short run, it has underperformed. Let's check like 3 years. 3 years it's almost even. Actually, it's up since 2020. It's up since 2019. What about 21? 21 it is also outperformed. So over the majority of timelines, this company has outperformed the S&P, which is exactly what you want out of a company, especially a company that is stable, right? And the other big reason I'm interested in this company, look at that dividend growth rate, 15.7%, right? That's exactly what I want to see. Payout ratio is only 32%, right? So they're still going to be able to raise that dividend, probably 10 to 15% a year over the next 5 or 10 years, right? That is exactly what you want to see. And again, they're still growing, right? They're still growing. I mean, let's check out the free cash flow growth here. Free cash flow, it was down a little bit in 22, but again, it's up massively since basically 2016. It came down in 2017, but ever since then it's been up, right? Again, 3.5 billion last year, 10 years ago, 771 million, right? So that's good growth, right? That's very good growth. If we look at other metrics here, return on equity, 23%, return on invested capital, 16%. That's solid, right? Profitability is down recently, but again, grocery stores are never overly profitable, right? They have pretty thin margins usually. So they're not like a software company or something like that where they're going to have massive margins. No, they get by on volume, right? And again, price of free cash flow 17, 5-year average just below 17, right? So in my opinion, they're at a price right now to where you could look to pick it up. I would prefer to get it a little bit cheaper, but they're at a price range right now where you could certainly pick it up. Again, obviously everything here, my opinion. Let's look at the 52-week range. High of about 62, low of just below 42. So, I mean, they're close to their 52-week low. They're only $3, just over $3 off, almost $4 actually, off their 52-week low. So again, that's pretty close, right? So, yeah, in my mind, this is a company you could look at picking up right now. And if we do get a recession, this company, I mean, we arguably are already. But this is a company that you certainly could look at picking up. Like you certainly could look at picking up because if we get a recession, it's probably not going to get hit as hard as most other areas, especially the SPY, the QQQs, and stuff like that, right? And as far as their earnings go, their earnings were 99 cents, 90 was the estimate, so they beat it. They beat it fairly easily there. Next one, Broadcom. Again, probably my favorite semiconductor company, not because they're going to grow the fastest, simply because I think they're one of the safer ones. And again, look at that dividend growth rate, 21% over the last 5 years. Payout ratio is still at 68%, free cash flow 47%. So again, they still have a lot of room to grow that dividend. I mean, if you'd have bought this company 10 years ago, you'd have a 34% yield on cost, right? That's just how crazy this company is growing, how fast. I mean, they're not growing that dividend. They're not going to grow it as fast probably over the next 5 years, but if they can grow it at 15%, 17, 18%, that's realistic. If you look at the free cash flow, again, every single year, free cash flow is going up. This is exactly what you want to see. Look at that. Just a perfect, beautiful chart, right? 16 billion in 2022, 486 million in 2013, right? So just crazy levels of growth. Again, it's not going to grow that fast over the next 10 years. If it can grow close to as fast, I think that's realistic. Again, look at 49% return on equity, just amazing company in my opinion. Again, price of free cash flow, 15, 5-year average, 14. This is one of the other big reasons I like this company is that if you compare it to an NVIDIA or AMD or a lot of these other semiconductor companies, they trade at very high valuations. Broadcom doesn't, right? These are the kind of companies you want, in my opinion. You need to be very careful with the valuations you pay for companies. As far as its earnings go, 10.33, 10.17 was the estimate. So again, slightly up. The last one, Canadian National Resources. As far as companies that I've talked about that I own, the only ones are Kroger, Broadcom, and this one. The other ones I don't own for reasons I already mentioned. This is a Canadian oil and gas company. One of the best ones, in my opinion. It's and not only that, it's well below its 5-year average valuation at a time where oil and gas prices are higher than that, right? So, and not only that, it's outperformed the S&P over the last 5 years and 3 years, right? So that's exactly what you want, right? That's exactly what you want. As far as the dividend goes, it's nothing crazy, but it's growing it, right? It's 4.4%, but look at that growth, right? Look at that growth. That's very nice growth. So again, that's what I like about this company, right? That's what I like about this company. Income was up 43% over the year over year. They also paid down a lot of debt last year, which is exactly what I want to see, because the less debt they have, the more they can return to shareholders, because when that cash flow is going up, but the debt is going down, they're going to use that money to, I don't know, buy back shares, raise a dividend, acquire assets so they can return more. Like, that is exactly what you want to see for a company, right? So very good company in my opinion. Also a company I think you can buy right here and right now. Let's look at the 52-week trend just to see. High of 70, low of 44. So it's actually a little above that point. But again, if you look at its valuation, it's not high by any means. So you could pick it up right now based on its valuation. So anyway, those are the companies I wanted to talk about this week. If you liked the video, hit that like and subscribe, and stay tuned for more.